the write-off receipts. So what is write-off receipts? A write-off receipt is like, suppose what is write-off receipt? So the instance is not properly, so we will going to discuss about the theory and definition. Okay, so basically write-off receipt is refers to the process to cancel an outstanding receivables or a part of that is deemed uncollectible. This is usually done when it is determined that the amount cannot be recovered from the customer, or such in case of bad debts or discrepancies that I will explain you. The write-off receipt process involves various suppose the identification of uncollectible receivables, create write-off entries where approval and the approvals, that is documentation. Let's take an example. Suppose we have if you have seen this transaction about the customer refund transaction. Here we have created the transaction of $9,000, but the receipt is of $10,000 we have received. So the customer has paid us in excess of the transaction. So if the customer doesn't demand to do the on receipt, that we have already developed on account receipt, where the excess amount will be adjusted. And we have also seen the customer refund, where excess amount will be refunded to the customer. So the customer neither ask for the customer refund nor it asked for the on account receipt. So if in that case we have to write off an excess amount. We have to adjust this excess amount, and so this excess amount will be the termed as the write-off receipts. So this is how the function of the write-off receipts will be come up here. So suppose takes an example. So just take an example of transaction. Suppose we have transacted of $9,995, and the receipts we have got of $10,000. So there is an excess balance of $5. So what we will do for the $5, because the customer neither want to adjust it nor wants to refund it, so there will be the option of write-off receipts in the Oracle Fusion. So for that, in the Oracle Fusion we have to set the receipts limits in the system options, where we have to define it, and we have to approve certain type of limits, and we have to create receivable activity as well. So the instance has not been processed because the instance has been changed, so our business unit will not be coming up. So we will see how this process will be done in the application. We will see in the next session as well. Okay, so now this is the write-off receipts concept. Now the other concept come up here about the revenue recognition. Okay, revenue recognition. So what is revenue recognition in the Oracle? So a revenue recognition is like that to a process of recording a revenue that we are generating in the financial statements, because in various if we are dealing the customers where we providing services or billing in different methods, this topic will be come up here. So revenue recognition refers to the process of recording the revenue in the financial statement. As we are doing, we are billing to the customers, or we are providing to the receiving the payments from the customer from where we are providing the services. So revenue in this fusion, the revenue recognition involves, because first we have to define the revenue recognition rules, that first we have to define this revenue recognition. So we have to define the rules. Suppose there will be a revenue recognition in 4 types. Okay. So revenue recognition here, suppose let's take an example. Suppose there is a 4 months contract with a customer. Four-month contract with a customer. So it is some 4 months contract with a customer of $10,000, $1 of $10,000. So so we are going to bill to the customer. So if it is a normal revenue, then we will enter this entry as receivables debit to revenue credit. If that is the normal transaction. Suppose now we are doing the revenue recognition, and there will be come up of the 4 months contract with a customer of $10,000. So we are going to bill to the customer in 4 equal months about the $2,500 per dollar. So every month we are going to bill this. So how this transaction will be recorded every month? So for that, suppose a first bill will be given us like that. That is the January. The first bill we will create is and we in the application we will record this entry: unbilled receivable debit to revenue account. Here the revenue has been recognized, but we haven't billed yet, but the revenue has to be recognized of $2,500. So in the next and same as the entry will be done in the February month, and the entry will be same as entry will be done in the March month. Suppose we are going to pay in 3 months. Suppose we can say on the April month. Let's complete it in the 4th month. So these 4 months we will record the invoice, that we record the transaction in the application like this: unbilled receivable to this. And in the 4th month, when the in the 4th month when we finish this, we recorded the entry, that is all the unbilled receivable entry will be write off, and we will just enter the entry of receivable debit to unbilled receivable credit of $10,000. So when this entry will be done, so all the unbilled entries which are debited will gone to the debit credit, and it will be write off, and the final entry will be turned like this. We have seen the first as well, of $10,000. So in this way we can be recorded in the we can record it in the inventories, we can record it in the entries. So this means where in this type of on transactions, it means that we are generating the revenue, but we are just stopped the billing. The bill will be available at the end of the contract month. So suppose the client has asked us that they don't want the bill to be stopped. So in this case we are going to enter the transactions like that we stop the revenue until the contract will be completed and the bills will be issued. So the entry will be goes like this: the bill has been created, receivable debit to unearned revenue, unearned revenue credited of $2,500. Same entry will be done in the Feb month, same entry will be done in the March month, same entry will be done in the April month. Still all the entries will be completed. So when the bill has been issued, when the revenue will be recognized at the end of the fourth month, that is the contract month, we were going to record the entry is entry like will be like this. So the entry will be gone to unearned revenue debit to earned, we can give the revenue credit $10,000. So the entry will be provided like this. So after writing of debit and credit, after writing of every debit and a credit, the entry will be like this: receivable debit revenue credit $10,000. So we can choose this and we can choose this anything. So it means here we are postponing the receivables, that is we are postponing the in bills, and in this we are postponing the revenue. So in the Oracle Fusion, with this this postponing the bill means arrears when we create the transaction, and for postponing the revenue the term will be used as advance. We will see when we will do this process in the Oracle Fusion Finance. So we have to do this setups. So for this setup we have to configure the auto accounting for revenue recognition. Then we will create the revenue schedules. The schedules will become like this, and it will be done. For this we have to maintain all the type of the transactions. So these are the two topics that we are going to do. So there is another topic, that is aging method buckets, that we will discuss when we will do in the sessions, and after that we will do like this. So So we are going to discuss this much in the today's session, and so we will do this all this all this configuration, all these setups and process in the next session. So thank you for joining us, and see you in the next.